Alright, man, it's your boy Webby, and today we're finally about to do like a beginner's guide on investing. Basically, I want to break down everything that you guys like, you know what I'm saying? Everything that you feel like could prevent you from wanting to learn how to invest, and anything that's mad confusing and all that. So, first things first, what the hell is investing? Well, investing is pretty much you putting your money into assets like securities, bonds, ETFs, and expecting a rate of return. That's what it is. In layman's term, or to put it in like I guess I could like dumbify it. I guess you could say, not that you're dumb or anything, but to dumbify it, it's pretty much putting your money into assets, right? Into assets on a brokerage account and expecting for your money to grow. If you buy the proper things, of course. You can't expect growth if you're buying things that have no expected rate of return, right? So, boom. What is part of investment? Investments doesn't mean only stocks. It doesn't mean only ETFs. It doesn't mean only index funds, mutual funds. It doesn't mean only options. Investments could mean real estate too. You could, I don't know, maybe you end up learning how to do real estate before you even learn how to invest on a brokerage account. That's fine. I mean, shoot, I invest into the stock market, but I've never invested real estate, at least physical real estate. I've tried, real estate, where it's like you invest. It's like a way. This is off topic, by the way, but this is like basically it's a stock that has a bunch that follows not a stock, but it's kind of like I guess you could say it's like a fund where it follows a project with real estate that is like controlled by a certain group, and based on how they profit or how that project does, that stock would go up. But I've tried that, and honestly, I did not see any gains from that. That was back in like 2021, 2022. Ticker symbol was O, I remember. I think it was. When I say ticker symbol, that just means the nickname or the abbreviation. That's a better way to say name. When somebody says, what is the ticker symbol for this stock or ETF, that just means the nickname. So, example, what is the ticker symbol for the S&P 500? That you probably heard that word so many times. S&P 500. What is the ticker symbol, or what is the nickname? It is VOO, or it's SPY. There's so many different ones. It's SPY. SPY is the most popular one. The one that Vanguard offers is VOO, which is the Vanguard S&P 500. Boom. That's what investing is. Next thing, right? What is ETFs? I don't know if you guys heard this one, but this is where most beginners begin. Not only beginners, I do this to this day. Most people who play like the safe route, I guess you could say, or want to know that they will have a guaranteed return on their income, goes the S&P 500 route, which is an ETF, right? If you buy it that way, it's an ETF, because the S&P 500 tracks the top 500 companies in the US, right? So you got all your good stuff that's been here for like 30 years plus that are always gonna do good. And the thing about ETFs, an ETF is pretty much like a basket of stocks all in one. Like, you buy one thing, but you get a basket of all this. So I'm gonna give you like an example, right? So think of McDonald's, right? Like that $5 meal deal, right? Instead of you, for my McDonald's people, I hope everybody can relate to this, right? So in the meal deal, you get French fries, a bev, you get nuggets, and you get a sandwich, right? Instead of you, that's the ETF right there. You see, you get for one price, you get all of that. But if you went the stock route, trying to get things, a bunch of different things, you have to buy the nuggets separately. You have to buy the fries separately. You have to buy the bev separately. You'd have to buy the burger separately, which would cost you way more. You know what I'm saying? And it wouldn't cover as much. That's the point. So with the ETFs, it covers like a broad market. You can see usually when you check out the ETF that you're purchasing, like the S&P 500, you can see what type of sectors it's in. What sectors does that ETF cover? Sectors meaning what type of company it is, or what industry is it. Is it consumer defense, or is it healthcare, or is it technology? Technology is the new popular thing right now because of AI and everything. Or there's a whole bunch of them. Or is it like retail? Or is it like retail consumer? There's a bunch of sectors out there, right? So that is what the ETF is. It's a basket of stocks bought for one price. Basically, you're getting a bit of everything for one price. That's what the S&P 500, the top 500 companies for one price, instead of you buying, I don't know, the 500 companies that are inside of that. But I always recommend every beginner for the first year to year and a half to just stick with the S&P 500, whether that's VOO. Don't forget, ticker symbol means the nickname or abbreviation, VOO or SPY. Or I know there's a Fidelity one, but I don't know it off the top of my head. Me personally, I've invested in VOO and SPY, right? So I've seen people who have thousands of dollars, like hundreds of $1,000s, like off YouTube, watching like investments, like where they have like $400,000 worth of, you know, assets in straight ETFs. It's only in ETFs, which shows you how like reliable of an investment it is. And some people, they go the other route, you know. But if I was you, I would learn what it is you need to learn about stocks, which is, don't forget, stock is like a single individual asset. That's what a stock is. That's the difference between a stock and an ETF. A stock is a singular asset. So like, okay, a stock could be McDonald's, and an ETF is like, let's say it's consumer, like the ETF was a consumer ETF. So every consumer stock that's inside there is a consumer type of stock in there. You get me? Feel me? So like, McDonald's is the one singular French fry, while I'm trying to, like, you know what I'm saying, it's the one singular French fry, and the ETF that you're looking at is a bunch of French fries. There you go. That's like a perfect example. Okay. On off to ETF. A brokerage account. A brokerage account is pretty much where it's the account you use to do the trading. Trading meaning buying the securities, buying the stocks, buying the ETFs, buying your options. Do not look into options. Buying your options. Not right now, at least. Buying your options and stuff like that. That's where you're going to do all your trading. That's what your brokerage account is. You got Robinhood. You got Fidelity. You got Charles Schwab. You got, where else? What else? Who else have it? There's a lot of small ones too. You got stuff like Stash, which is a very low-key one. But that's more like auto investing, I guess you could say, or robo advisor, like where you pick your type of style. I'm going to get into that too, so I'm not going to get too deep into that right now. Who else? I said Vanguard. You have Vanguard also. I'm trying to think of the big boys, the big names that everybody knows. And I said Fidelity already. I said Robinhood. I feel like I'm forgetting one. It's actually annoying that I'm doing that. What is it? I'm just trying to go based off what I have, but those are pretty much the big ones. Anyways, there's different type of brokerage accounts, right? After you open an account, let's say I go on Robinhood right now. I said I want to open an account. When I first started, I opened an individual investing account, meaning when I open an individual investing account, it's not meant for your retirement, you know? It's not tax advantage to your retirement. So when you start investing, I believe you should start investing with a Roth IRA, like IRA, meaning everything that you put in is already taxed and you're not going to get taxed in the future. So you don't have to worry about that type of tax. Obviously, there's little things if you sell early, like, you know, a capital gains tax or short-term capital gain tax. There's stuff like that, but everything that you're not going to get taxed for the gains you make into that account, because everything is already after tax dollars inside of it. Everybody should open a Roth IRA. I feel like that's the first account you should open up. Me, I did the opposite. I did individual investing account and a Roth IRA. So yes, so the Roth IRA has a limit to how much you could put in there. I think right now it's $7,500 for anyone like 18 through like 65 or 60. I don't know exact age number. And anyone above 65 or 60 can put like $8,500. The reason why this is very good, why the Roth IRA is very tax advantaged, because like if you're making like a lot of profit within that account, like your tax, you don't have to worry about the taxes, because you're holding, if you think about it, you most likely will be holding everything, like your positions meaning what you invested in from the very beginning, or your current place when, like, let's say you bought, I don't know, McDonald's at, which is probably not realistic since I'm making this video, but let's say you bought McDonald's at $50 and it's right now it's $300 and you always hold it. Your position is that one share at $50 if you bought only one share, right? Which I also have to get into about the whole share thing, right? So yes, that is why Roth IRA is more advantage, because you don't have to worry about the whole tax thing compared to if you put in an individual investing account, right? Then you would have to worry about taxes and stuff like that. I'm not saying you wouldn't have to worry about taxes ever when it comes to a Roth IRA, but it's the Roth IRA is literally just tax advantage for that, $7,500 limit. So shares. What is a share? You're gonna hear that one a lot. People are gonna say, "Oh, he has 1,000 shares of this." It basically just means how much. How can I put this in like layman's term? Like how many of that? There you go. How many of that stock or ETF or how much of that asset that you own is what a share is. Pretty much like okay, one share would be the one full price of whatever it is, right? So if I have a stock, if I bought a stock at $100, right? One share would cost $100. That's how much it's trading. The trading price is how much it costs. So if the freaking Call of Duty stock, right? I'm just making things up. This is probably not real. Maybe there is a Call of Duty stock. Let's say Call of Duty stock costs $100, and I say, okay, I'm gonna buy that today as of June 9th. I bought that $100. I have one share. Let's say I have faith, or I did a lot of research that this stock is gonna go crazy in the next 10 to 15 years. I'm like, okay, I'm gonna buy 1,000 shares, right? So you have to do 1,000 times 100, which would cost roughly $10,000. I think I did my math. I think it's $100,000 actually. So that's how much shares I'd have. 1,000 shares, and it'd be worth 100,000. And yeah, so shares is pretty much how many pieces you have. There you go. How many nuggets do you have for your investment? Look at it like that. How many chicken nuggets you got left? Right, so I buy one. Let's say I buy the S&P 500 ETF VOO, ticker symbol VOO. Don't forget, ticker symbol means nickname. VOO, right now I think it's at 6 something, like 640, 630. So I have one. Let's say I have one share. That means I have one piece of that share, that ETF. That's all it means. Shares are just pieces. How many pieces of it do you have? And there's things called fractional shares. Fractional means like a piece of a piece. So it's like some brokerage platforms or trading platforms, trading apps, right? They don't allow you to do fractional shares. Basically, if it costs $6.89 for you to get, you have to buy the full thing. Like on Robinhood, you can get pieces of it. Like if I don't have $689 right now to buy something, let's say I have $345 right now, and I could buy about half of it. I could put that $345 and still get the asset, which is kind of good because I started off on Robinhood, and obviously I was making way less money back then. So there's no way in hell I was gonna buy like a $200, $300, ETF at the time. But the way to do it is, I think starting off with fractionals is the way to go. A lot of people will feel otherwise. I realize some people feel otherwise about fractional shares, but I feel like it's a good way to get your foot in the door. Like there's no way you're gonna be like, yeah, you could save. You could always save and until you have enough to buy the full share, but I feel like the price is gonna be moving up and up because it's meant to be going up. Because on average, the S&P 500 goes up about 7 to 8% per year, which means a guaranteed return. So it's like when something is moving, you kind of want to get in, to be honest. But yes, a quote to always remember with the stock market: always buy low, don't buy high. Don't sell low, don't buy high. What does that mean? That means when things are high, you should be kind of hesitant on buying it, because why would you want to buy? That's like there's a pair of Jordans that just dropped. They're pretty high. You know what I'm saying? They're pretty okay, and they're going for 300. And the price is gonna go down after some months, after the hype is done, to like 200. Why would you want to buy it at 300 knowing it's not worth 300? It'll most likely be at the actual value for 200. You know what I'm saying? That's what it means. Because then you won't really, benefit off of that, you buying so high. So don't buy at highs. I've made that mistake so many times when it came to, this has nothing to do with, I'm not even going to get into this, but when it comes to crypto, I've done that before. When it comes to certain stocks, I've done that before. So stuff like that. But yes. So trading platforms, I've named ETFs. You guys should know what that is by now. Don't forget, that's like a basket of stocks all in one. You get like an all-in, think of it like an all-in-one package, right? S&P 500 is the one that you should be focusing on. Another thing, now this is just like a tip: do not get emotional when you see your account in the red. It is normal. Always remember this. Here's some things to know. I want to name some things to know now, right? There will be good days, there will be bad days. There will be sometimes bad years. Those are called a bull market, right? I'm bugging, not bull market, bear market. I'm sorry. That is called a bear market. Why is it a bear market? Why is it called a bear market? I'm not sure why they call it a bear market when things are red. Red meaning that things are down and most likely your account, balance, like your account is performing bad, or your assets, to be honest, are performing bad, and you'll wake up and you see that you're in the red. Red meaning, everything that you bought, you're probably losing money, right? Losing money is okay as long as you know the investment, if it's just the S&P 500, is going to correct itself. Correctly meaning eventually it will go back up. Okay, I'm gonna take some examples. The year 2020, right, was the biggest recession in a long time. Everything was down. To some people, they panicked, they sold, and so people lost a lot of money selling. When you put too much emotions in this thing, you will come out a loser, right? But for the people who were smart enough, they kept buying. And you're probably wondering, if somebody's losing money, why are they gonna keep buying? Look at it. 2020 had the most opportunities because things that were so valued or overvalued are now at like a discount sale. It's like you go into freaking Walmart. This is a good example. You go into Walmart, that freaking PC that that anywhere you go would be $2,000. All of a sudden it's going for $1,000. You telling me you wouldn't get that PC? It's 50% off. Probably, well, in this case during 2020, probably way more than that, right? So more like $800. That's an example. There's no way in hell you wouldn't hesitate getting that at that price. So when the market is in the red, do not panic. You have to look at it like it's an opportunity to buy more, because now it'll cost you less to have more. That's what you want to know. So let's see, the S&P 500, like I was just saying, let's say VOO is worth 630 as of today, which is June 9th, and then I don't know, next week we go into a recession or something like that. Now it's worth 539. That's your chance to put more money. Now you have more chance for your money to grow. Don't sit there and be like, oh my god, I'm gonna lose all my money and then sell it all. No. The year 2020 was an example. A lot of people became rich from that year. Like, no bullshit. A lot of people who had leftover cash put a lot of money into different assets, different stocks, ETFs, and then when everything came back up, they sold, and boom. Just like with Bitcoin too. Do not look into Bitcoin yet. Get your knowledge about it, but don't go heavily into it. You want to be in the stock market first. Like, yes, you can have a small allocation or portion of your money into it, but it shouldn't be majority of your portfolio. Portfolio meaning your whole. When somebody says, what's your portfolio look like, it's basically what does your investments look like. Where is your money allocated? Where's your money? What assets is your money in, basically? It could go from stocks to crypto to real estate to different type of businesses. Your portfolio can consist of different type of assets, is what a portfolio is, right? So what you want to focus on when you're just starting is learning. Learning is important. You want to learn from different people, credible people I learned from. When I first started, the people that I watched to understand what I'm looking at or what the fuck I'm doing was Graham Stephan, Graham Stephan, because he was like one of the biggest YouTubers at the time. I was learning during COVID, so 2020. Graham Stephan is a good one. I'm starting to lose names because Wall Street Trapper is a recent one that I started watching. He's really good, like really, really good. I can't lie. But he's more like stock type of guy, He's more of a stock type of guy, but he does talk about ETFs too. He's put me onto some good ETFs that are definitely surrounded by this whole technology thing at the moment. And I'm trying to think of other people that I watched. Graham Stephan was like the biggest one though. Graham Stephan, Wall Street Trapper, Chris Sain, that's another good one. Like Chris and then Sain, like Sain. That's another good person to watch. I'm trying to go back in time. There's another guy, and Andre Jick, yes. His older videos though. Right now I'm not really like a big fan of his newer videos. I feel like it's all politics now. But Andre Jick, so it's AndreiJikh. Andre Jick's older videos, so like 2022 and before. You could just search it up. You could literally be like investment. The best thing to do is just go on YouTube, investing for beginners. Boom. There you go. Investing terms. So actually get deep with this thing, bro. You wanna sit there and learn. Like, you want to cram your brain with this so you know what the hell you're looking at. Like me, I'm still learning. There's a lot of things even I don't know. This is sidetracked. Like, this is a little bit off topic. Like, I don't know. I know how options work, but I've never done options trading before. I'm not gonna probably get into that. Probably not necessary, but it's nice to know what you're looking at. Like the whole calls and puts thing. For people who already know what I'm talking about right now, I don't understand how options work, and yes, it's more risky, but I've seen people like Wall Street Trapper do it a lot, and he knows what he's doing. I've seen people who sit there and watch Wall Street Trapper and they take his courses and stuff, succeed with those type of things. But me personally, I don't really look into that stuff right now. But I guess knowledge is good knowledge if you know what you're looking at. All knowledge could be good knowledge if it's worth the value. What else? There's certain things where there's certain things like when you look at it, like looking at a graph. Like some people are able to look at a graph and not predict, but I guess you can say kind of estimate where the next trend on the graph would be. So things like that, stuff like that nature, I wouldn't say like I'm proficient in, because I'm not like day trading or anything like that. But some people, they do look at that to kind of estimate where everything's gonna be. But honestly, the first thing you want to do, open that brokerage account, right? After you open that brokerage account, you want to put some money in, automate some money in every week, whether that's 10, whether that's 20, whether that's 30. Me, I started off with 30 a week, which was back then, and all I did was put in the S&P 500, put in the S&P 500, put it just every week. I had to automate, put it on like a recurring transaction kind of type of thing. And every week you want to just do that. So another thing to keep in mind too, right? Another thing by keeping in mind too is, don't think just because you're putting money into a safe, investment doesn't mean you're gonna be a guaranteed return on your investment right then and there. You know what I'm saying? So you might wake up today, like me. As I'm recording this, I'm gonna look. Maybe I'll even show a screenshot, right? I could go into my brokerage account right now, and if I look at my like individual investing account, which is the first account that I opened up, I could see if I'm in the red, right? As of right now, the market's open right now. I'm not in the red, but there's days where you be like, okay, holy shit, I'm down like, I don't know, 20% or whatever. So that just shows you can't be putting so much emotion into it. I remember the year 2022. 2022 was a bear market, meaning down. When you hear bear, down, I don't know why they use the terminology bear and bull. Bull means the market is good and it's going up, it's green. Bear means it's going down and it's red. So that's nice to know. Remember that too. I think it has to do with like the physical structure of those animals when they're like around. I guess like when a bear is looking for food, it's like facing down, like its nose is down and it's sniffing on the floor. I think that's what it is. I'm not sure. I never looked into it, but that's what I thought. Every time I you search a bear market, that's the position, or that's the way their body is posing and like looking down and snooping down. So I thought that's what it was, maybe. But and a bull is always up because it's trying to like charge at you and stuff like that. So maybe that's what it is. But anyways, that's off topic. So every week you want to put money into it and have it automate your trades. Automate your trades is what I'm trying to get at. You always want to automate your trades and consistently every week have it invest, no matter what. No matter what. You always want to do this. And also, don't invest in things that is hype, bro. If you think it's hype, you probably wouldn't even know if it's hype actually. If it's just hype, bro, don't freaking do it. Like for me, I fell into that whole thing before. Cause I was like 19 at the time. I'm currently 23, and the whole AMC or GameStop thing. If any of you guys know, you know. If you don't, then you know. Basically, it was like this whole hype when GameStop was closing down a lot of different stores. The price was just going crazy for no reason. I at the time didn't understand why the price was going crazy, but I was like, oh, let me hop in on this. I don't remember if I even made money off of it, but who knows? Stuff like that, you could put a lot. Imagine where you put a lot of money at the top. Like I said, you buy high and then boom, it just crashes right there. There's nothing you could literally do. Like if it never recovers, then it's like, yeah, you pretty much lost your money. You know what I'm saying? Another rule to remember about investing: don't invest more than you can't handle. Like, don't sit there and invest your lifetime savings all in one. Let's say, I don't know, you had $10,000 in a high yield savings account. You're like, I'm gonna take all this $10,000 and invest it. Not that if you invested it in something, like, don't invest money you need now is what I'm trying to get at. So like, if you need something immediately, don't do it. Though the type of investment strategy I feel like is best when you're beginning is holding on for dear life, which is basically putting money in something and never selling it until, like, I guess it's time, like, I don't know, retirement, or most likely retirement is what it is, whatever age you decide you want to retire at. So basically holding on for dear life. So me, as of this year, I'll probably take a screenshot so you guys don't think I'm capping, but as of this year, from the very first time I started investing to now, my portfolio is up 50%. And I didn't invest in anything specific. Obviously, yes, it's great timing because I was part of the 2020 market, the 2022 market. My portfolio is up 50%, right? 52 point something, some weird odd number like that, which shows you this thing is very good. Like, investing is, it's like this is investing in savings, right? You should always save too, don't get it twisted. Savings is good. Like, if you guys are not saving at the same time you're investing, then you're playing the game wrong, bro. Feel me? So you want to invest and save at the same time. Like, put your money in a high yield savings account and invest. I don't know how much you make, but me, when I first started working, I'm going to be transparent. When I was 18, I was working 2 jobs and I was in college at the time. So that's probably a little leverage I might have over you guys, but obviously it's me deciding to go out there and get it. So whatever works for you. But I'll just use one job as an example because my second job didn't really make much. First job, I was a security officer. I was making like $3.19 for the part-time hours. I worked 24 hours, and I think my check was $3.19. It sounds right. Pretty sure it's $3.19. The math sounds like it's right. But anyways, yeah, $3.19. It was like $3.19 after tax. What I did was I put like a majority of that. Like, I probably, like, by the time I was done, like, all the transactions from investing and all the transactions from putting my money in a savings account, I probably had, after all that, maybe like 180, 170 to do whatever with. And if me, I was such on that that I just, if whatever money that I didn't have to pay bills with, I just put it right in there. So at the time, I think my only bill at the time was the electric bill. Yeah, it was the electric bill. Yeah, that seems about it, because I didn't even have a car yet. Like, not that I didn't have a car. What was it? A car loan. I didn't have a car loan yet at the time. So yeah, I had my car was already pretty much just, a second-hand car. So that's the benefit of that. The point is, don't be emotional about your investment. Stay true to your investments. Make sure you're investing in things that you understand. Don't invest in it because your friend said to buy it. Like, I don't know. Like, for example, I kind of made that mistake recently with, like, SpaceX. I had a coworker tell me, yo, you should buy SpaceX at the IPO because, it was opening up. And I bought 2 shares. I can't lie, because I know it was gonna be a good investment. But it's like, I probably should have waited, because I think it went down a little bit. Probably should have waited instead of buying it at the time of all this hype, honestly. Because I was thinking it, but I still did it, which is what I'm trying to say. Like, don't feel like you have FOMO. Like, don't feel like you have fear of missing out on something. That's another rule. Like, don't sit there and panic buy because you think, oh, this is gonna be the next big thing when it's at like the all-time high, bro. Don't buy at all-time highs. Honestly, just let it come back. Everything has to pull back. Always remember that. Everything has to. When things are performing way more better than they usually do, there's gonna be a pullback. Like, if the S&P 500 is performing, I don't know, 6% in 1 month, most likely eventually it's gonna pull back. But yes, consistency is what's gonna get you there. Always consistently invest. For me, I'm gonna give you mistakes that I made so you can learn from my mistakes. I like to do that because I feel like you can learn from others' mistakes and not only your own mistakes. Number one, right? Try to keep your spending low so you have enough to actually invest. The year 2022 was probably one of the best years to be investing because it was a bear, like, I think it was like a recession market. Recession meaning, like, everything is like down and it's correcting itself. Prices that were constantly going up or correcting and going to its actual value. I think that's what was going on that year. There's a lot of things going on that year. So basically, the whole year was in red. It was a whole bear market that whole year, 2022. But Here's where I made the mistake. I was in like a financial situation where I had to be paying something off constantly, and I never had money to constantly invest. Right? I mean, I might have had a little bit, but not the whole. Like, it wasn't investing at that point. Like, I was so focused on other things, and I had a lot going on at the time. Just personal things that I didn't get to take advantage of that year. So that's one thing. And you want to be like, try to keep your spending as low as possible so you have money to invest, right? Another thing, don't emotionally sell because you think something's performing bad. If you do that, you will never ever realize your gains. You will never be able to profit. You will never be able to have a successful, like, basically build wealth. You won't be able to build wealth if you keep putting emotions in this. If you know something's good and you see several other people telling you it's good, and statistically it's proven to be a good investment, which is the S&P 500, then there's nothing for you to be scared about. If you want to do your own research, if you prefer trusting yourself, do your own research, and you'll know that this S&P 500 is a good investment. So that's another thing. I've had moments where I've emotionally sell, but I was in the beginning, of course, so I was still learning. I've had moments when I emotionally sold and I took the back end of it. Like, for example, this is an individual stock. It's not S&P 500. There's this Taiwan Semiconductor stock, which makes the semiconductors for many different companies, including AI. So there's this guy who told me, like, yes, you should hold on to this for a while. Trust me, in the future is gonna be good. I bought it around, like, if I remember, like 100 something. As of today, I think it's at. I'm actually even gonna check it right now, just because. I believe right now it's somewhere in the 300s. Obviously, I only had one share, and probably would have been like 443, and I bought it at 120 at the time. And I sold it at like 200, so I still made profit. But if I had held on to it, that would have been like a $300 gain right there. And after I, because I already wouldn't have to worry about taxes because I had it for like 2-3 years plus. But yeah, it was in the red so long that I got nervous and thought it was just a bad investment, but it just didn't really took my time to understand what I was, investing in, which is what the issue was. So don't emotional sell. Another thing is always try to invest in things you understand. Don't make trades based off what people are telling you. I don't know why I recently made that mistake. I'm not saying that I'm biting the dust because of it. That position is still up, but still, make investments on what you understand and what you know with your knowledge. Understand if somebody's telling you something, do your own little research. Try to do your own little research. Was what I'm getting at. This is actually not going to be a little tip or anything, but you're going to hear about robo-advising. You probably won't know what that means. Robo-advising is basically, I'm going to sum that out real quick. So robo-advising is pretty much where they ask you, what type of investor are you? Like, are you a beginner investor? Are you a risky investor? Stuff like that. Basically, it does all the heavy lifting for you. Me personally, I have a mixture of both, right? I have account like Stash, there's an app called Stash where it literally asks you all this information. What type of investor are you? How do you want your account diversified and stuff like that. It basically, it's a one and done type of thing, and every week you put money into it and it allocates all that money the way that you set your strategy. It's not bad at all, actually, because you really do, like, I did a mixture of both. So I did Robinhood, where I do my own investments. Charles Schwab, I do my own investments. Fidelity, my own investments. Yeah, I'm kind of all over the place when it comes to these platforms, these trading platforms. You don't have to do it that way. Keeping your money all in one place probably makes it way more easier for you. So if you want to open your Roth IRA with Robinhood and your individual with Robinhood, go ahead, or with Charles Schwab. Just know certain ones offer a fractional and certain ones don't offer fractional shares. Fractional shares is a piece of that piece, pretty much. So like a slice of a slice is what I'm trying to get at, right? So I believe beginners should start with fractional shares. That's just me. That whole, maybe you don't know how somebody's income is, so trying to buy something that's worth $600 might be tough. So I feel like being able to get in for like $10 or $50 or $100 or $200 or 50% of whatever it is kind of nice. If it's down at the time, like for the week, it would be nice instead of having to wait until you had enough to buy one full share. But yes, robo advising is pretty much they ask what your strategy is, they ask what's your goals and all that. Basically ask you a whole bunch of questions, and they try to build a portfolio for you. And obviously they're not going to give you money or anything, but it's like they set up the portfolio where you have money invested each week, and you obviously set up your bank account, and they invest it in that way. Like for me, I use this app called Stash, and with that app, that Stash, I don't remember what type of strategy I use. I looked at mine the other day, but it seems like pretty much it's mainly S&P 500. And obviously you can do little individual investments in there. Like what I mean by individual, like trades in there. Like you choose certain things that you want to trade like manually instead of automatically. So that's what it is. It's pretty much everything is done automatically for you based on every question you answered and responded with. Like, how do you want this? How much of this do you want in there? So it basically does the heavy lifting. But I feel like you will never learn like that. You can do that as a second account if you want to just, do that for now while you learn. That's not a bad idea. But I learned both. I understand both. So I most of my money is not in that whole automatic robo advising or robo investing, I should call. It's not part of that whole thing. Most of my money is like within like my 401k. I didn't even get to that actually, which is another retirement account. 401k is like your account that they offer you at work, and they give you a match. So like, let's say you put 3% of your paycheck before taxes, because don't forget 401k is before tax money. So you put 3% of your 401k. You set 3% of your 401k from your check, right? And then they match that 3%. Each company is different. Some company does dollar for dollars, however much you put in, they put in too. So basically 401k is like free money to be made. I have a 401k with my job. I think everybody should if they have a company that offers it. If you're young, the better. The younger, the better, right? So that's that. But honestly, start off small. Do your research. I need you guys to be in them books. Like, read some books too. Search up investing for dummies, investing for beginners. Shit, even watch those kids videos. You'll be surprised at how valuable the knowledge is in there. So start with the kids videos if you need to. Start with those YouTubers that I named. They're really good. Wall Street Trapper, Graham Stephan, all those people. And to get as much knowledge as you can. Specifically, I feel like for a whole year you should be focused on the S&P 500. Don't obviously learn about other things, but don't invest in them yet because you don't have the experience to be doing so. Like me, yes, I have individual stocks in some of my individual investing accounts, right? But most of my money, majority, if I had to guess, like 70 to 75% is all in the S&P 500, and it's never failed. It's never failed me. So yeah, that's what you should be looking in. Don't be emotional about this whole thing. It might sound scary, it might sound complicated. When you're looking at those graphs, it sounds complicated, but if you search up, in beginner graph reading, or beginner graph analysis, it's not that complicated, bro. All it does is shows you how the stock is performing one day, 1 week, 1 year, all time high, all time that's been performing. That's usually what the graph is showing you. Some graphs look scarier than others. Like the Robinhood graph doesn't look as scary, but when you look at something like Charles Schwab, it might try to scare a beginner away, but it's really not that complicated as you think. So anyways, with investing, the more time you have on your hand, the more your money is able to grow in the market and compound. So don't forget that. Start today. Don't hesitate on it. Get on that right now. Get on it right now. Learn, gain your knowledge. Always try to sit there and consistently every week or every 2 weeks, however you get paid, consistently put money in there. I promise you, you will see the results. It's your boy Webby, and we out.